Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Dhruv Nagrath, Director of Fixed Income Strategy at BlackRock. So we're talking about fixed income investing today in the second quarter and beyond. BlackRock, as we know, is the world's largest asset manager. They offer over 430 ETFs in the US markets, including 128 fixed income ETFs, both active and index tracking, across a variety of strategies. Dhruv, welcome. Great to have you with us today.
Thanks, Nina. It's great to be with you.
So we are recording this on April 10th, and we got a very hot inflation report this morning, which has raised doubts about when the Fed will be able to start cutting interest rates, and expectations for a rate cut by June fell from about 57% odds yesterday to just about 19% chance today. And the market is now pricing in less than 2 rate cuts this year. And in fact, at the beginning of the year, traders were pricing in 6 or even 7 25 basis points rate cuts by the Fed. And obviously, after this hot inflation report, bond yields surged and stocks fell. And some experts are now also talking about the possibility that the next move by the Fed will be a rate hike, not a cut. So let's start with your outlook for interest rates in 2024. Will the Fed cut rates this year? And if yes, then by how much and when?
These are all the million, billion dollar questions, Nina, that we're asking right from the outset. It's definitely been an eventful day in terms of news flow, and this does flow on. I mean, this CPI reading is the third consecutive month where we've seen a positive inflation surprise relative to market expectations. So this is maybe testing markets' consensus or resolve around the idea of the Fed cutting rates this year. But I think it's important to kind of maybe take a step back and recognize that we knew that the Fed had made progress on bringing inflation down, right? So coming into the year, I agree. I think I agree with the comment that markets were predicting 6 cuts. That was a little bit excessive in our thinking. Our view, our base case amongst our fundamental kind of fixed income investment teams, Nina, has been that this year it's more likely 2 or 3 cuts, and it was more likely going to be in the second half of the year. It was not too long ago that the market was actually expecting cuts as early as March, and we thought that was a little bit overdone, right? So having said that, the interesting thing and this is something that Jay Powell in recent commentary has said, that there's we have to be a little bit patient with understanding the inflation data, I think the ride down to 2% as a notional kind of target for the Fed is going to be a bumpy ride, right? It started this inflation reading, of course, this morning was again a positive surprise, but this kind of maybe slight shift in the news flow has followed on from a very strong jobs print from last week as well, right? So if we're kind of zooming out, we're thinking about the economy. It's a stronger economy than everyone was expecting a year ago. But the Fed has been able to progress towards the idea of something of a soft landing, where inflation comes down from the excessive levels that were a byproduct of the great reopening after the shock of the pandemic a few years ago. But at the same time, can the Fed? The question was, can the Fed do that while maintaining a relatively healthy level of growth? And that's what the US economy is kind of surprised on, is this this continual kind of creation of jobs. And and immigration has been a driver of that as well, in terms of providing slack to the economy. So it's creation of jobs without having that excessive inflationary pressure, right? So they've made progress. Basically, let me get back to your question. The key takeaway is that we think that this morning's reading is definitely a positive inflation surprise relative to expectations. What does it do? I think we have to recognize that we have to be data dependent and patient in terms of understanding that, look, the services side of the economy, inflation there has been stickier than expected, right? And the Fed might need to kind of just to see that data play out. Our base case is still for cuts this year. I know you mentioned that there might be some commentators calling for hikes. Maybe the policy setting is not as restrictive as people that people thought it might be. But I think it's also a recognition that the economy is it's a different kind of economy to the traditional kind of goods-based economy, right? This is a more services-based economy, and let's face it, monetary policy can be a blunt instrument. So maybe. That's kind of the tricky piece there. But yeah, our kind of view is yes, you could have 2 or 3 cuts probably in the second half of the year, but the really key thing is that we have to be mindful and respectful of the data and how it comes through. And the key kind of takeaway from today is that the services side of the equation is a lot stickier than expected. Hopefully that's helpful for you, Nina. I know I shared a lot there,
yeah.
But hopefully that kind of gives you a sense of what we're thinking.
Yeah, I kind of agree with you that we could see some rate cuts 2 or 3, but they are coming later this year, definitely not in June. So based
bit
on
of a delay.
Yes. So based on these expectations that these short-term rates will stay elevated for the time being, money market funds have been gathering a lot of assets, and that is mainly because of those juicy 5% yields on these money market funds. And last week, in fact, money market fund assets rose to an all-time high, exceeding $6 trillion, we know. But there is some research which shows that when interest rates peak, which appears to be the case now, then stocks and bonds typically outperform cash over the subsequent year or so. So I was interested in your thoughts on why now is a good time for investors to step out of cash. Could you talk about that?
Yeah, definitely, Nina. I think this is probably the most relevant and interesting discussion that in my role as a fixed income strategist at BlackRock, I get to speak to wealth managers all around the country, and this is really the question on everyone's lips is, okay, how do I think about my cash allocations? You rightly pointed out. Over $1 trillion went into money market funds last year. That's almost the size of the US high yield bond market. In fact, I think it was 1.2 trillion, right? So that's the kind of flow that went into money market funds. And of course, that was, now you are not penalized for being a saver and putting money in those money market funds because you were getting, like you said, the juicy yields at the short end of the curve. The problem or the challenge or the risk to that is that if we think about the Fed's journey on its hiking cycle, we are somewhere near the end of that hiking cycle. That's what we've been all, trying to prognosticate about and figure out, well, when does it end and when do the cuts begin? But the problem is that when the Fed eventually does start cutting, now whether that's June or it's later in the year, let's table that discussion for a moment. But when the Fed does start cutting, the market will price that in before the Fed's actually given you the green light, right? And so this is why it's such a relevant discussion. Is there's 2 things. There's 2 big risks. Is reinvestment risk, right? So those juicy yields you referred to at the short end of the curve, they can come down very quickly, and so you're reinvesting then at lower rates. But also there's the risk of missing out on potential price appreciation further along the yield curve from that that benefit of duration, right? Interest rate risk. Now, to be clear, we don't think that you need to go all that far out on the yield curve to kind of get some of that duration benefit. We've been looking at opportunities in the intermediate part of the curve. What does that mean? 3 to 7 years. If I had to choose a number, 5 years, that's the specific kind of spot that we've been looking at. But we do think that this is a meaningful time to be thinking about portfolios. We did a bit of a historical look back at past hiking cycles, and it's really you mentioned stocks and bonds outperforming. This is the period where they typically will, which is the period between the last hike and the first cut. That's a period where we've seen bonds. Just obviously I'm a fixed income guy, so I'm going to focus on bonds. Bonds historically, on average, have outperformed cash by almost 10%. So it was 14.8% looking at some of our historical studies. That was the return for bonds compared to 5% for cash. So that's the risk and the opportunity cost associated with just sitting in cash. I know that there's a reason for the inertia there, but this is the conversation that we've been having with a lot of clients is, hey, thinking about duration. Now, just to be clear, the short end of the curve is still a great place to be, but we do like the idea of adding a bit of intermediate duration to the portfolio, and it can potentially help as well as a potential risk-off, equity diversifying hedge as well.
Right. It is very important for investors to understand and be aware of the opportunity cost of holding too much cash in their portfolios now. So you mentioned soft lending, the possibility of a soft lending by the Fed. So where the economy continues to expand at a healthy pace, which is happening as of now. We have seen that economy continues to be resilient, continues to do well, and the inflation will continue to ease over the coming months. So if the Fed is able to manage to engineer a soft lending, then which areas of the fixed income market look attractive in your view? Where do you see opportunities for investors?
This is a great question. I do appreciate the question because the opportunity set in fixed income is actually very attractive. Just thinking from a broad portfolio construction perspective, the really interesting thing is you don't need to take a lot of risk to get a healthy portfolio yield that can get you up to about 6%. Without taking on the full risk of stocks, for example, you can actually make a healthy return, generate income. I mean, income is the name of the game, using your fixed income assets. So, look, obviously, I mentioned to you earlier on in my slightly rambling spiel about the belly of the curve. We like the intermediate part of the curve. So in treasuries, going up in quality, we have seen a lot of clients allocating a lot of money to just high quality treasury type exposures. So that's been great. But if we talk about soft landing, what's implicit in that view is that the US economy is in a stronger place than really we were calling for last year. Last year, everyone avoided high yield, and it actually ended up being a really strong performer, right? In the context right now where, yes, high yield spreads are tight, right? So on a valuation perspective, high yield spreads are tight. But from a fundamental, just from a yield perspective, you can get a yield, close to 8% in some parts of high yield. And on a fundamental basis, if we think that this soft landing narrative has got legs and it's a strong one, which we do believe in this idea of the strength of the US economy, then the high yield sector could be a great place to add yield into a portfolio. So that's one that we've turned constructive on in some of our recent outlooks. We like being a little bit more thoughtful about how we approach that sector of the market. So we have, for example, we've got funds that have systematic screens that try and screen out the riskier issuers and then tilt towards undervalued issuers. The ticker there is HYDB, which is our kind of systematic screened high yield ETF. That's kind of a smarter way, I think, of targeting that part of the market. And then, look, if you don't have as sanguine a view of the US economy, or if you want to get, maybe just a little bit more defensive in that, then using, a high quality investment grade short duration exposure, something like an IGSB, which, targets the 1 to 5 year part of the IG market, you're getting a healthy yield, 5.3%, a short duration of 2.5 years. And that's been a pretty neat way of kind of going up in quality in the market. So look, the credit space is where, we've been looking at the opportunities. If we do think that the soft landing narrative comes to pass, for those more adventurous investors out there, there's a lot of opportunities in things like emerging markets and that whole complex.
Sure, that was very helpful. And so those are the opportunities for investors. Let's also talk about the potential risks. So in your view, what are the biggest market risks currently facing fixed income investors? Is it the possibility of a rate hike now? Or do you think rising fiscal deficit is a concern because that may lead to a surge in bond issuance by the government? Or are there any other risks that investors should be aware of?
So it's very healthy to kind of think about it through both those lenses, right? We talked a bit about the opportunities, but then thinking about the risks. I mean, today is actually a great illustration of this, right? So we've talked about how, before we got on this podcast, I was looking at the 10-year had moved higher by 18.6 basis points on the day. The 2-year had moved up higher by 21.6 basis points on the day. These are big moves, these yields. So there is a risk of potential steepening if the inflation picture is firmer than expected. But you pointed out, the Treasury issuance. And we, obviously we did have a Treasury auction today that tailed. It was a more challenged kind of auction. I think the key is how do you enact your view? So we are a little bit cautious of the long end of the curve. So 10 years and out, because of the dynamics that you mentioned, as well as the additional volatility that you take on in the form of interest rate risk, we're not so much in favor of kind of using that part of the curve for your Treasury exposure for our base case in terms of risks. So that is a risk there. Having said that, if things really do precipitously kind of collapse, from an economic perspective, then the classic playbook for that kind of trade is actually holding long dated assets, right? If you think rates will rally so that's the flight to quality. So, I've given you kind of two views on it. We right now, in terms of our tactical positioning, are avoiding the long end of the curve because of the risks associated with steepening. But that it can rally if you have a really precipitous kind of collapse in the economic picture, right? So those are the two-way kind of things to do it. The other thing that I'd say is in terms of addressing the risk associated with inflation. An asset class that's been a little bit out of favor for the past, I'd say, a year or so, a year and a half, as the Fed has made some progress in bringing inflation down, is TIPS, right? So TIPS, Treasury Inflation Protected Securities. One neat little way that you could kind of build a hedge into your portfolio allocation is to use something like an STIP, which is our short-dated TIPS exposure. It's targeting the 5 years and in part of the curve of the Treasury of the TIPS curve. That obviously TIPS securities adjust with higher than expected inflation readings, so that could be a neat way of kind of having some inflation protection into your portfolio. You can also use TIPS term maturity ETFs. I don't know if we've spoken about I-bonds before on your podcast, Nina, but that's definitely been a very big popular kind of theme across the clients that we speak to.
So I also wanted to discuss stock bond correlations, because that has been one of the concerns for many strategists lately. And in fact, I read a recent research report by your BlackRock Investment Institute. And that report said that prior to 2021, stock bond correlations were stable and negative for almost 20 years. And that began to change in 2021. And we have not gone back to the norms of previous decades. And correlations now remain positive and significantly higher than they were pre-pandemic. So obviously bonds are now not providing the kind of diversification benefits that they were providing in earlier decades. So One of the biggest investment case, one of the biggest arguments for investing in bonds within an investment portfolio has been their diversification benefits. So if diversification benefits go down, should investors reevaluate the 60-40 portfolio model? Should the percentage of bonds in a portfolio go down in your view? Could you talk a little bit about that?
This is a fun one. I say fun from a very geeky fixed income perspective. But you get a lot of press commentary that's dedicated to this kind of discussion around reevaluating the 60-40, etc. Look, it depends on your risk appetite. If you're a long-term investor, a broad mix of stocks and bonds is going to make sense. 60-40 is like the kind of classic moderate allocation, but as we know, it varies across to different investor types and their stage of their stage of life and their risk appetite, etc. We think a broad mix of stocks and bonds will still make sense, but I think it's about being more nuanced in the views that you're taking within your fixed income, right? So, for example, I talked about being a little bit cautious around the long end of the curve. But then, if you look at like I said, the intermediate part of the curve, you've now got a healthy yield cushion, right? For example, we've got an ETF that targets the 3 to 7 year part of the curve. That's, and obviously with today's yields, it would have kind of repriced higher. But if you're getting a yield, pull it north of 4.3 or 4.5% on a 5-year treasury, you've got a healthy kind of yield cushion there that can withstand a bit of volatility if rates go, as in if yields go higher, right? So you can take a bit of a price hit because you've got the income cushion from the higher yields. That's a very different picture to a couple of years ago when rates were next to zero, right? So I'd say that bonds, yeah, look, I think correlations can be a bit more challenged, especially at the long end of the curve. But I think there's some pretty healthy buffer yield cushion kind of benefits that are still accruing to some parts of the curve. I think it's just about being a little bit more nuanced about the view you take. And then the second thing I'd say is the role of alternative assets and private markets has kind of edged its way into the 60-40 discussion. So, again, I'm not being prescriptive here. I'm just saying anecdotally, I hear clients talking a little bit more about a 60-30-10, where the 10 might be made up of private markets, and they might provide some degree of diversification of your overall return outcomes that maybe previously you might have relied a bit more on your bonds to do that, but you've got an alternative kind of return stream. And we're living in an age where, on the one hand, ETFs over the past couple of decades have really democratized access to the public markets, but we're actually living in an age where access to the private markets is also getting democratized through a lot of product innovation across the industry. So I think it's easier and easier now for wealth managers to build in a bit of an alternative allocation into their portfolios. Hopefully that kind of gives you a perspective on how we see it, Nina.
That makes a lot of sense. And since you mentioned ETFs, let's talk about the popularity of ETFs, which is one of the interesting trends that we have seen in recent years. That is the popularity of bond ETFs. And last year, global bond ETFs gathered an annual record of over $300 billion in inflows. And of course, iShares led with $113 billion in bond ETF flows. So could you talk about this trend and what is driving this adoption by investors?
Yeah, definitely, Nina. I think, in addition to the stats that you mentioned just now, another one that I looked at just recently was if you think about the past 4 calendar years, right? So past 4 full calendar years, 2020, 2021, 2022, and 2023. These were some of the most challenging and volatile years in bond markets on record. You had multi-decade highs in inflation. You had the fastest hiking cycle since the 80s, taking rates from 0 to 5.5. It's a big deal. In that time, each of those calendar years I mentioned, bond ETFs in the US saw around $200 billion a year of inflows. It was about 201 in 2020, 203 in 2021, 200 in 2022, 190 in 2023. These are staggering numbers. And so I think we're seeing really widespread adoption of bond ETFs. They grew from, BlackRock launched the first 4 back in 2002. And, it took a little while to get to the first $1 trillion globally. It actually took about 17 years. But then to $2 trillion globally, it actually just took another 4 years after that. So globally, we're sitting at about $2.2 trillion of assets. We think that number will be $6 trillion across the industry and across the globe by 2030. And I think to answer your question, there's some pretty big drivers that I'd call out on a structural basis. Firstly, I think advisors and investors, wealth managers and individual investors are really rethinking the cost of building portfolios. ETFs give you, significantly kind of lower fees than traditional fixed income mutual funds. They give you competitive performance, low cost, I mentioned, of course, and liquidity and access, right? Access is the kind of the key name of the game, that the ETFs kind of give you access to the fixed income markets, which otherwise, can sometimes be a little bit more illiquid and opaque in accessing. So there's the access piece, right? And that's the story there. The second thing is, you can finally make money in fixed income again, right? So the silver lining of that painful hiking cycle from the Fed is that now you've got healthy yields across the curve. You've got healthy opportunities to make income in spread sectors. You can make money in fixed income again, and ETFs give you a really efficient way to do that. A very straightforward, efficient vehicle that has become synonymous with portfolio construction on the equity side. Equity ETFs make up about 10% of the overall equity market. Fixed income ETFs make up only 2% of the overall fixed income market. So there's huge runway for growth. The last thing was a more thematic thing last year, which I'd call out, is that there were tax loss harvesting opportunities in fixed income, which people are very familiar with on the equity side. It actually came to be available on the fixed income side as well. So those are a few of the themes I guess I'd call out. Rethinking the way that investors build portfolios. Putting money to work in fixed income because you now can, and then harvesting some tax losses as well. These are some of the drivers that we've seen causing some of that structural adoption of fixed income ETFs.
Very interesting. And another very interesting trend that we have seen lately is the popularity of actively managed ETFs, particularly within the fixed income space. We have seen so many interesting actively managed fixed income ETFs, and some of them have been doing quite well too. And one of the ETFs which I find very interesting is your actively managed fixed income ETF. It is the BlackRock Flexible Income ETF. The ticker symbol is BINC. This has been quite popular with investors, and it is now approaching its 1-year anniversary. So could you talk about client adoption of this product and how your clients are using this ETF in their portfolios?
Yeah, definitely. It's one that a lot of us at BlackRock are quite excited about as well. Just before I do focus on BINC, I will say this is a theme that we're seeing across the industry. That last year was the highest highest year on record in terms of new active fixed income ETF launches. There were 66 in the US, and that's up from 43 in 2022. So a lot of new products coming to market in the active ETF wrapper. And I think that is a recognition of a lot of the benefits of access, liquidity, transparency, and efficiency, tax efficiency, especially of ETFs as a wrapper. And so there's more and more issuers that are adopting the ETF as a wrapper. We've been launching and running active ETFs for over a decade here at BlackRock, so it's not new. But there's something new about BINC, which is that our fundamental fixed income CIO, Rick Reeder, who is responsible for, I think, over $2 trillion. His team is managing BINC, the BlackRock Flexible Income ETF, and we've seen some really pleasing adoption of the fund since it launched back in May last year, as you kind of called out. It's actually approaching, or it's over $2.7 billion in assets under management, which for any fixed income ETF launch is quite remarkable. But the reason I think it's kind of grown so significantly is that it's actually filling a need that a lot of advisors that I speak to and just individual investors as well and wealth managers that they face is that accessing some of the plus sectors or the spread sectors of the fixed income markets, right? The areas where you take on more credit risk in exchange for higher compensation, for higher yield. That's a thing that there are a lot of people who don't necessarily have the know-how or expertise in making a call between, are we going to invest in US high yield or European high yield? Are we going to invest in US dollar denominated or local currency denominated EM debt? Are we going to invest in CLOs as securitized products? Or are we going to focus on non-agency mortgages? Like, these are the kinds of things where it has made sense to have the expertise of an active manager, and so we've seen it for investors who don't want to play in that space, but we've also seen it from investors who want to use the kind of the security selection know-how of an active manager in that space to work that BINC allocation into a model, right? So model portfolio management is really growing in the wealth industry in the US, and so BINC has been a really neat way of kind of like filling into that space. So to give you just to wrap it up in terms of my excitement about BINC, it is a flexible income ETF that plays in the parts of the market that are not your traditional core sectors that make up the Bloomberg Ag, right? So it's by definition actually limited to only 20% holding in those traditional core treasury and IG corporate type assets, and it's playing in some of those sectors that I called out earlier on, like high yield or EM debt or securitized. And it's been a very thoughtful kind of way to building a high yielding portfolio. It's got a yield of around 6.7% today, which is a similar yield to the US high yield BB index, but significantly less realized risk over that period of time. It's got a third less risk than the high yield BB index since inception. Obviously, it's a shorter inception date, but it's basically capturing high yield like levels of yield with a lower level of volatility because it's diversified across all those different sectors that I mentioned. So look, and it's an exciting one, and so in terms of duration, also it's kind of sitting between it's got a band between the 1 to 5 year part. Right now, it's got a duration kind of 2.5 years. So it's been a pretty thoughtful way to kind of access the yield opportunities that we've been talking about today in the fixed income markets. Right, this is definitely a time to put money to work, and we've found that a lot of clients have used BINC as a great way to do it.
Great stuff, Dhruv. We'll have to leave it there. But thank you so much for joining us today and for sharing your insights. Really enjoyed the conversation.
Thanks for having me, Nina.
That was Dhruv Nagrath of BlackRock. Now, let's quickly recap some of the ETF tickers that we discussed today. So if you want to look at high yield space, and that is if you believe that the economy is going to remain resilient, then you could consider the iShares High Yield Synthetic Bond ETF, the ticker symbol HYDB. It provides exposure to high-yield corporate bond market, but focuses on high-quality issuers only. Now, if you want to look only on investment-grade bonds, then the one he mentioned was ISGB. So it provides exposure to intermediate-term investment-grade corporate bond market, 1 to 5 years. And for inflation protection, he talked about the 0 to 5 year TIPS bond ETF. It is STIP. And then we also talked about the actively managed fixed income, flexible income ETF. And the ticker symbol there is BINC, BINC. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.